Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. So the big news obviously today was that non-farm payrolls number that came out this morning. Everybody was billing it as the jobs report to end all jobs reports. It's the big kahuna, which it seems like that's what the jobs report is billed as every month. And then you just recycle that, repeat it, basically I guess till the end of time. Next month everybody will be looking, depending on what the Fed decides to do with their September Fed rate decision, they'll be talking about that jobs report as being the jobs report to end all jobs reports. But this morning we came out, we got a disappointing number, and the number on the surface didn't even tell the whole story about how disappointing the numbers were. Going into yesterday, expectations were at 180,000 non-farm payroll ads. Then yesterday we got strong data in the form of ISM non-manufacturing and initial jobless claims, which caused Goldman Sachs, for one, to raise their expectations to 200,000 job ads. And I think a lot of people were also expecting a little bit more than that 180,000 initial number. And we came in, we got 169,000 ads. But then we also saw the July number revised down by something like 60 or 70,000. And the June number was also revised down slightly. And then you saw a lower participation rate lead to lower unemployment number. You saw a 7.3% unemployment rate, which is representative not of a bunch of job gains and anything positive. It's a sign that fewer people are actively looking for jobs, which is a really discouraging sign, even more discouraging than the fact that people are looking for them and not finding them. So the number, the 169,000 on the surface, wouldn't appear to be disastrous, but the number was a lot worse than it actually looked, and I think it could potentially change the Fed's thinking a little bit in terms of that September rate decision. At least that's the perception from the market, I think, based on today's reaction. If we take a look at the chart of the S&P, we had some real big volatility, and I'll go into the reason for that in a second. But what happened this morning with that non-farm payrolls number is bonds were able to bounce. Bond yields came down sharply on that report because of the perception that the Fed might be less likely to taper QE in September. And as a result of that, stocks were actually unfazed by that non-farm payrolls number. So stocks actually held up, opened higher. But then the big news that hit the tape, and you look at the candlestick of the spiders today, and you might even think, wow, E-signal's messed up. There's an erroneous print being shown on the chart here with that big tail on the candlestick. But what you had was Vladimir Putin at the G20 come out and say that if the U.S. decides to strike in Syria, that Russia is going to be there to support Syria and they're going to respond. And obviously that triggered some initial fears about a potential escalation of the conflict, about maybe a conflict between Russia and the United States, which would be a much bigger deal than just some military strikes in Syria by the U.S. And so it caused a big reflex drop. I'll take a look at, we'll use the 13-minute chart, East Coast time frame. Take a look at that. I mean, you had a really sharp drop, maybe a little bit of an overreaction. Some tough talk there from Vladimir Putin, but not sure how much the market even really believed him, or they believe that there's any possibility of escalation of a conflict between the Russia and the U.S. based on this Syria stuff. And that's maybe why you got the snapback in the next 45 minutes to an hour or so. A really frustrating day, I think, for a lot of traders that were looking to be active, because you saw that big sharp drop, and maybe people were looking to short bounces. I know some people I talked to were looking to short a bounce on that initial drop during the day, or on the initial bounce after that big drop, and they never really got that move back down that a lot of people expected based on those doomsday headlines regarding a Russia and U.S. potential conflict. So if people were sitting at their desk and trying to be active today, a little bit of some tricky action with a V bottom, a really quick drop, and a really quick snapback. But the result of the day was we finished slightly positive. And if you look at just the change of the day overall, you'd say that nothing really happened in the market today, when in reality there was a lot that happened, but we really just spun our tires and didn't go anywhere. Taking a look at a couple of factors that were affected by that non-farm payrolls number this morning, you look at TLT, the bond ETF. As you can see, it was able to bounce sharply after really plummeting yesterday. And it plummeted even further after hours yesterday. The 10-year Treasury note yield actually exceeded 3% for the first time since 2011. But then on that non-farm payrolls number, the perception is maybe the Fed's less likely to taper in September. And so what did you get? A bounce in bonds But then that bounce was faded. You look intraday, look at the 60-minute time frame, and you can see we gapped up. We're initially strong, but then that gap faded. So maybe some of that expectation started to fade during the day as people came to grips with that non-farm payrolls number. And it's still anybody's guess about what the Fed's going to do in September. But even John Hilsenrath, the Wall Street Journal reporter who's considered the mouthpiece for the Federal Reserve in the media, he came out with an article about an hour ago talking about how that September Fed rate decision is really a cliffhanger, is how he described it. They're really keeping everyone guessing right now. He could see them going either way with the decision, either tapering or not tapering. So it'll be very interesting to watch what expectations appear to be over the next couple weeks as we get closer to that Fed rate decision. But right now, guessing it's a 50-50 type of thing. I don't think anybody has any real inclination either way. Maybe it'll be smaller than people expected, but they'll still taper. That's the type of scenario I could see playing out. But it'd be interesting to pay attention to what expectations become. And oil also strong today based on renewed fears in Syria. You had that stuff with Russia coming out and threatening to back Syria in any potential conflict. Obviously, that's going to spark some fears about a larger escalation of a conflict. And you saw oil come close to breaking out today. Oil stocks are what we've been focusing on. Oil sort of is subject largely to headlines. And so a couple of the names that we talked about in Off the Charts over the last 2 weeks were EOG and Schlumberger, SLB. And Schlumberger has been the more noteworthy one of the two, had the better price action. Today it was strong again. Actually closed a little bit off the highs, but still really constructive price action there for SLB, and one that I expect to continue higher after breaking above the pivot here from about mid to late July. So instead of trading the underlying commodity, I think more often than not, it's safer and I think just better overall to invest in and trade oil companies. And Schlumberger appears to have one of the better charts, and financially it's a very healthy and sound company as well. The social networking stocks continued to outperform the market and really lead the way. Facebook, another enormous move. Obviously the level that I keep harping on that we talked about in Off the Charts, in morning calls, on Twitter. If you follow us on any of those mediums, we talked about the $36 level being a 50% retracement from this post-earnings move that you saw. So you got a retest of that 50% retracement level, which is a place you want to see a stock hold if it's going to maintain its healthy composure. And Facebook held that $36 level, and obviously you've seen really strong gains since then, over 20%. Today it extended really nice momentum despite news that their potential video ad in your news feed setup might be delayed because they're worried about potential backlash from users about putting video in people's news feeds, video ads. But the stock faded a little bit into the close, but still really impressive price action there. LinkedIn has responded really well from that secondary offering. It doesn't look like insiders are trying to cash out. It just looks like the company is looking for a little bit more growth capital. And as a result, the stock has been able to break out. Really impressive move to engulf the gap down from that secondary offering, and then another extension today. So really impressive work there from the social networking stocks. And then Yelp is not really social networking, but it's one of these new media type stocks. Did the wrong symbol there. Yelp, huge move today. It was upgraded by Deutsche Bank before the open. Just another example of what these new media stocks have been able to do in this market, really lead the way. People are piling into these names. Institutions appear to be piling into these names as the growth story seems real. It did close a little bit off its highs, so signaled it might need a little bit of rest, but really healthy action here in Yelp. And if you're looking for stocks that are weak, I tweeted yesterday, I said, right now is a time that I feel much more comfortable about getting into shorts more aggressively than I would be about really piling into longs. Yes, you can't count out this market ever, and maybe it's foolhardy to even think short in 2013, and it's a little bit taboo. But right now it feels like there's a lot more risk if you're holding longs than there is risk if you're holding shorts, and it seems like there's potential large amount of reward if you're holding shorts. But what things do you want to be shorting in this environment? I'm not a big fan of playing the spiders, playing indices. I don't think there's much of an edge there. But you want to look to short the weakest stocks and the weakest sectors. Those sectors will be sectors that I've talked about that will underperform in a rising interest rate environment, which is what we are in and what we will continue to be in as the Fed tapers QE either in September or beyond. They're going to taper eventually, and we're going to get higher rates, even though we have had a big move up in rates already. But you talk about those sectors that are going to underperform in a rising interest rate environment. You're talking about the defensive sectors, the dividend-oriented sectors. And that's led by the utilities, the Utes, XLU, not Utah, not the Utah Utes, but XLU, utilities. Broke down obviously below this bear flag here. This came back up to retest it. Not a bad risk-reward spot to look short on the utilities. Came back up to the 8-day moving average. And like I said, a retest of that prior breakdown. You could see another downside move in the utilities down to this pivot from late June. That would be a sizable move, but we were already there in June, and that's not a unfathomable target for that trade. You zoom out even further to the weekly chart on the utilities, you can see how far they came this year. Wouldn't be surprised if we continue to be in a rising interest rate environment to see the utilities back at the $35, even $34 level. We have some support there. That would seem to be a natural target for me based on, you're seeing sort of a macro H pattern here. This H pattern is something that you see Mike and Steve talk about in their momentum trading room. You can apply the H pattern on all different time frames, not just intraday. And that's what you're seeing a little bit here with XLU. You saw a big breakdown. You saw a bounce that was rejected. I don't know what Fibonacci level that is, but a large majority of that bounce was not reclaimed, and then we've broken back down to that prior trend line low, and a break of this slightly rising trend here in the XLU could trigger more downside. I think this is one that will continue to go lower. Another one, XLP, consumer staples, another dividend defensive-oriented sector. Now we'll go back to the daily chart to start with XLP. Another one it's slightly less defensive and dividend-oriented than something like the utilities, but the consumer staples are another one that have bounced back up. It is back above its 8-day moving average, but still below its 21-day, well below its 50 and 100-day. So that tells you that it's overall weak, and obviously a big tail with the market today. This is one that if it breaks this rising trend line here, this mini ascending channel, I expect to see more downside. I expect to see a move back down to the lows here around 39. You zoom out again to the weekly chart on the consumer staples, and you see there's a big level here around 38.87. If we do break below that, not a whole lot of support at all here. You have maybe a little one from this candlestick, this weekly candlestick, with the low at 38.20. But beyond that, from late 2012, that would be obviously a sizable move. I don't know if we'll see that much downside, but talk about pure technicals here around the $36, $37 level. That would be a natural technical area if it did break this upper level pattern to the downside.
Rob wants to say something about inside.
Apparently Rob in the chat room wants me to say something about inside bar. What bar was inside? I've got my producer talking to me right here. Inside week on the SPY. Let's go back to the weekly chart. As you can see, Rob Smith's strategy, outstanding room. His community is very good about helping each other identify patterns, and not only in indices but in stocks as well. If you have not been exposed to Rob Smith's strategy at all, I would highly recommend taking a free trial into his mentoring room. But like I was saying, inside week in the SPY, which means the price action of this week was contained within the last week's candlestick. So we'll be looking for a breakout of that inside week candlestick next week to determine which side of the trade the people in Rob Smith's room perhaps are going to look to be on. But like I said, outstanding, a little bit different type of strategy that Rob Smith hosts in his room, something I'd highly recommend. And I think it's an outstanding, different flavor of technical analysis that Rob brings. The feedback we get in his room is outstanding. But moving on, taking a look at the chart of the XHB, which is another sector that I think will underperform in a rising interest rate environment as mortgage rates, interest rates will go higher as well and perhaps hurt the housing market. And you're seeing, a downtrend form here in the XHB. You could also say inside week in the XHB according to Rob's strategy. And even, if you talk about conventional technical analysis, you talk about a wedge pattern forming on the weekly chart here over the last month or so. This is another one that I expect to continue to the downside. You could even talk about a more macro wedge that you could use to gauge your price action here in your trade entry. So if we get a break above or below this wedge, that could be your entry. But I have a tendency to lean to the downside in XHB. It's one that you talk about support there. I'd say the first target for that would be around the $26 level, which is the consolidation area that we were in when we entered this year. Housing had a decent start to the year, but it's come off a lot. So just like those other defensive, dividend-oriented sectors, sectors that will underperform in a rising interest rate environment, I expect weakness in XHB. And then you talk about housing, a derivative play of housing, sort of. I think it's a component in the XHB ETF, I believe, but Home Depot, a stock that's been incredibly strong for the last few years, is one that's really showing a lot of weakness right now, and the jig could be up a little bit here for Home Depot. You take a look at that chart here. One that, you go back to the daily chart, you get a better look at it. What we look for when we're looking for stocks to short, you look for a stock that has a topping type of pattern, which here was a double top for Home Depot. It pulled off sharply during June, but then bounced impressively off the 100-day, back to highs, but then got rejected at highs, broke down out of sort of an upper level flag that formed here, and then it's formed basically another lower level bear flag after this sharp breakdown here. And what we're seeing over the last few days, this is one that we've listed again and off the charts as a short candidate. What we're seeing is a breakdown out of this flag, this wedge, whatever you want to call it, and you've seen continued relative weakness from Home Depot. Yesterday we saw that break to the downside. Today we saw, despite a gap up, more downside from Home Depot. It did close slightly off its lows, but one that I expect to continue to underperform. It is breaking a key level here. It was able to close back above that key support level today, but if it does break down there, you could see it first down to this little cluster of support around the $68 level, and then deeper than that, obviously you have a support level down here around 64, which would be you could say that it'd be a big move to the downside, but you look in the context of the move we had over the last few years, it doesn't actually seem like all that big of a move. So you have to put everything in context, look at everything in perspective if you really want to get a clear picture of trade expectations and things like that. But that'll about wrap it up in terms of the things that we've talked about most this week and how they've performed in the market. We do our best to identify stocks that are moving as well as market trends and potential news and headlines, and we try to interpret that for you about how it's going to affect the market. But right now, in a very headline-driven tape, you have speculation about QE tapering. You have the whole Syria debacle, which has been absolutely botched by our administration, and obviously we're close to getting ourselves in a mess here. You talk about Russia showing a little bit of pugnaciousness, talking about potentially responding to any strikes that we provide, make in Syria. And this is just an environment that there's so many reasons to be more cautious and to be more short-term that I've talked about a lot this week. When you get a headline-driven market, that's not the type of market that's conducive to calculated, planned, strategic trading, which is our foundation here at T3 Live. So we're not going to tell you to be over-aggressive doing things in a market like this. Yes, we'll point out stocks that are moving, patterns that look good, and you could even create a long-short type portfolio that balances sectors and stocks that look like they're going to underperform in the current environment versus ones that look like they could outperform. But in general, keep things tight, keep things short-term, keep things tactical, and just wait for a little bit more clarity. You're never going to get full clarity in the stock market, but right now you don't like to trade very aggressively when headlines are dominating the tape. This has been John Darsie here for your daily recap. We'll see you out here at the morning call on Monday.